Right now, Plug Power, ticker PLU, is trading at $2.65. That's a drop of $0.10 or 3.70% on the day. For the thousands of investors who have been watching this stock, this 3.70% slide isn't just another bad day. It's a symptom of a much deeper existential crisis. The immediate thought for many who see this name at a fraction of its former glory is, this must be the bottom. This is the ultimate buy-the-dip opportunity for the future green hydrogen economy. But the reality is, this $2.65 price reflects a market that is pricing in a genuine, non-zero possibility of total failure. The immediate thought for many who see this name at a fraction of its former glory is, this must be the bottom. This is the ultimate buy-the-dip opportunity for the future green hydrogen economy. But the reality is, this $2.65 price reflects a market that is pricing in a genuine, non-zero possibility of total failure. The expectation for Plug Power has always been that it's the leader of a new energy age. The reality is that it's a company burning cash at a terrifying rate, and it may not survive to see the future it has been promising for over a decade. This isn't a growth story right now, it's a survival story. The common belief, the narrative that sent this stock soaring to over $70 a share just a few years ago, is incredibly compelling. It's the reason why Plug Power is a constant fixture on investing sites and a popular topic for self-investing communities. The pitch is perfect. Plug is building a vertically integrated, first-of-its-kind green hydrogen ecosystem. They aren't just doing one thing, they are doing everything. They build the electrolyzers, the picks and shovels, that split water into hydrogen using renewable energy. They are building massive production plants in Georgia and Texas to create the green liquid hydrogen, the fuel. And they sell the fuel cells, the engines, that consume this hydrogen, most famously for forklift fleets in warehouses run by giants like Amazon and Walmart. This vision of a one-stop shop for decarbonization is why so many retail investors, perhaps on their Robinhood app or SoFi Invest account, see this $2.65 price and think it's a coiled spring. The entire bull case is now hinged on one single catalyst: the finalization of a $1.6 billion loan guarantee from the Department of Energy. This loan is seen as the ultimate validation, a government backstop that will provide the liquidity to bridge the company from its cash-burning present to its profitable future. But that expectation is colliding headfirst with a brutal mathematical reality. And that's what today's 3.70% drop is truly about. This sell-off isn't about the size of the hydrogen market in 2040. It's about the size of Plug's bank account in the next quarter. For years, this company has been haunted by one fundamental, horrifying problem: negative gross margins. Let me be clear about what that means. For long stretches, it has cost Plug Power more to produce and deliver its hydrogen and equipment than it has been selling them for. They were, in effect, paying customers to take their product. This is a level of cash burn that is simply unsustainable. This isn't a high-margin software business like NVIDIA stock or a cash flow printing machine like Apple stock. This is a heavy capital industrial manufacturing business that has been operating with the balance sheet of a speculative startup. The new green hydrogen plants, especially the 15-ton-per-day facility in Georgia and the upcoming 45-ton-per-day plant in Texas, were supposed to be the magic bullet. By producing their own hydrogen, they would finally get costs down and achieve positive margins. But the market's patience for this promise has run out. These plants have faced delays, and the market is deeply skeptical that they can operate at a cost that actually saves the company. This is why the $1.6 billion DOE loan has become the single point of failure. The company's going concern warning late last year, an official statement that it may not have enough cash to operate for another 12 months, sent shockwaves through the market. While they secured stopgap financing, the underlying problem of negative margin operations wasn't solved. The company is in a desperate race against time, burning through its remaining cash as it waits for the DOE to sign the check. Today's drop reflects the growing fear that the loan might be delayed again, come with crippling terms, or, in the worst-case scenario, fall through entirely. The macro environment is amplifying this pain. High interest rates are poison for capital-intensive pre-profit companies like Plug. An online investment in Plug isn't a bet on a stable company, it's a binary bet on a financing event. Professional traders, the kind using sophisticated interactive brokers platforms, are not modeling Plug's 2030 revenue. They are modeling its quarter-to-quarter cash on hand. The risk of insolvency is not zero, and the stock price reflects that. The daily trading action in Plug is pure sentiment. This isn't a stock you put in your Fidelity IRA and check in on in 10 years. This is a stock that can swing 20% in a single day on a vague press release or a rumor about the DOE loan. It behaves less like a stable industrial company and more like a highly volatile Robinhood crypto asset. The volume on today's 3.70% drop is significant, suggesting it's not a low-volume drift, but active selling pressure. The stock is pinned below every major moving average. Institutional ownership from large funds like a Fidelity mutual fund has been wary. While some hold it as a speculative position, many large conservative managers won't touch a company with a going concern history and negative margins. This leaves the stock in the hands of retail speculators and high-frequency traders, which is why the volatility is so extreme. This is not a stock for a set-it-and-forget-it Schwab Intelligent Portfolios account. This is a stock that requires constant monitoring, a high risk tolerance, and a deep understanding of its dire financial situation. The investment help most people need on Plug isn't what's the price target, but what is the actual cash balance as of today. So, for anyone new to this name, let's just quickly recap what Plug Power actually does. It's built on 3 pillars. First, the legacy business, GenDrive fuel cells for material handling, which means forklifts. This is their most mature market with big-name customers, but it's not growing fast enough to offset the cash burn, and margins have been historically weak. Second, the picks and shovels play. Electrolyzers. These are the machines that a company can buy from Plug to make its own hydrogen. This is a high-growth potential market, but it's competitive, and again, Plug needs to prove it can build them profitably. Third, and most importantly, is the green hydrogen fuel business. This is the big company betting dream, building a coast-to-coast network of hydrogen production plants, starting with Georgia and Texas, to become the hydrogen station for the world. This is where all the capital is being spent, and it's the source of all the financial pain. It's an unbelievably ambitious, capital-intensive model, and the company is trying to build it all at once right as capital markets have tightened. This brings us to the future outlook, and at $2.65, there are really only 2 paths from here. The first path is the bull case, the narrow road to survival. In this scenario, the $1.6 billion DOE loan is finalized. It is signed, announced, and the funds are available. The stock would almost certainly double or triple in a single session on that news alone. This loan would provide the liquidity bridge Plug desperately needs to survive the next 18 to 24 months. But the loan isn't a victory in itself. During that window, Plug would have to prove its model. The Georgia and Texas plants would have to ramp to full capacity, stay online, and, this is the most important part, they would have to report a quarter with positive, sustainable gross margins on their fuel business. If they can do that, they prove the entire vertical integration thesis is viable. Analysts at major Fidelity brokerage firms would be forced to re-rate the stock, and a genuine recovery could begin. The second path is the bear case, which is the default path if nothing changes. The DOE loan is delayed again, or it comes with such severe terms like massive warrant dilution that it crushes existing shareholders. In this scenario, the company's cash burn continues. They are forced to execute another at-the-market